Hi everyone. So today is our first event speaker at the LSESU Financial Inclusion Society. My name is Emma. I'm the head of Yunus Club, and we are delighted today to have Mr. Sushil, who is one of the vice president of one of the largest microfinance funds in India. And today we're going to discuss on the economics of the bottom of the pyramid lending in India, as well as the microfinance financial inclusion landscape in India. So the session will be around 40 minutes, and then will be followed by a Q&A. Hope you like it.
Right. Super. Thanks so much, Emma. Thank you for the introduction. Thank you, Soham and William, for having me here. And the ones who have come there, I think you're braving it on a rainy Wednesday. Coming, and I believe you don't have classes, and you've come in. So you're the brave ones. My intent in this session is, I will try to take you through the economics of the bottom of the pyramid lending, in a more statistical and graphical manner. I'm more of a numbers guy. So I try to understand the language of numbers. I do have some experience in statistical programming as well in R, etc. So I will try to, probably try to talk your language to the extent possible, right? So, let's move on to the first slide. If I may request the presenter to move on. What I will do now is I will take you through the broad microfinance or financial inclusion, industry in India. And what I've tried to do here is I've tried to highlight some of the statistics and some of the key data points, the one that you can see in red, right? So if you look at it very closely, and I know there's too much of data, it's a very busy slide, but just to give you some highlights, the number of microfinance borrowers in India is actually almost the same size as the population of the United Kingdom. So if you look at the unique borrowers on the chart on your left-hand side, top corner, there are 6 crore, that is 60 million unique borrowers that exist. And probably around that is 60 million borrowers and 120 million loan accounts. So every borrower, in a way, has 2 loan accounts that are outstanding. The reason I've highlighted some of these parts in red on the left 2 charts is you can notice that this is a duration where there was COVID. And if you look at the bottommost chart, you can see the dramatic fall that happened during the COVID. This is COVID wave 1, that is Q1 2021. That's April, May, June, and Q2, July, August, September. And then the wave 2 that happened the next year, that is Q1 21-22. You can look at the dramatic fall that is happening in this period. Now, at the same time, I invite you to look at this slide on the right-hand side, this graph. Sorry, not this, this graph here. This sector, the microfinance sector, has actually been a very resilient sector. So if you look at the par is basically, how many days have you not paid the loan? So portfolio at risk. So if you look at the leftmost dots, the par 30, that is 30 plus overdue, 90 plus, 60 plus, 180 plus, have been sub 2-3% almost historically. But if you start looking at those surges that happen in, a spillover effect in the first wave of COVID and the second wave of COVID, then you can look at the par 90, which is one of the key leading indicators of, a loan turning bad, inching towards 10%. So you're talking about an industry which had delinquency levels of sub 2-3%. And because of COVID, it's shot up to 10%, which is quite astronomical. You can consider that this industry, like any banking finance industry, operates on very thin margins. So when you have a 5x increase, and you notice it continues, it's not something that has abated. It also continues right up to June 2022. This industry, to give you a perspective on the absolute volumes, the gross loan portfolio outstanding is $40 billion. And, I think it's very easy now to say dollars and pounds and euros because of some, interesting, politicians and chancellors. All the currencies, are almost the same. So we don't have the challenge of saying what's differentiating with a pound and a dollar and a euro, right? I mean, it's statistically insignificant. The p-value is very high. So, it's almost the same. Now you're looking at a quarterly disbursement of close to $5 billion and an average loan size of, $500. So that's the landscape of the industry that we are talking about here. Now, these loans are primarily given to people who are generating what we call livelihood. And out of this, almost half of the loans are given for agriculture, and almost 13% is given to animal husbandry, that is agri-allied sectors, and 30% to small businesses. So putting together agri, animal husbandry, small businesses, you're almost covering the entire landscape of the microfinance loans. Now, this sector, it is so large from a perspective, and it is a very evolved sector in some ways. It is not evolved in some ways. We'll get to the extent of, in what ways, but it has had multiple interventions. You had scenarios where you had state-owned banks trying to solve this, private banks trying to solve this. And that is when what we call microfinance institutions came into the picture. And banks took the support of microfinance institutions, or what we call business correspondents. Business correspondents are basically people who work on behalf of the bank for the loans. The bank does not have a physical infrastructure in place, so they work on their behalf. The business correspondents contributed significantly. Business correspondents are basically legal entities that don't give loans, but they facilitate loans. People have also tried cooperatives, what is called as farmer producer organizations, FPOs, and the cooler word now is agri-techs, right? I mean, people have tried agri-techs, people have tried, you must be knowing, self-help groups, joint liability groups, all of this, multiple things have been tried in the sector. This is as old as Grameen Bank, and Grameen Bank was somewhere in the 1980s, if I'm not mistaken, or prior to that. So there have been changes, there have been evolutions. Some may say that, hey, do you have government intervention, right? I mean, there have been government interventions, but all but one government intervention has been successful. All the other government interventions have caused failure in one form or the other, which I'll take you. There should be just been one innocuous government intervention that has rapidly and dramatically changed the entire microfinance space. That was innocuous. That was not by design. I'll take you through that. Now, the growth of MFIs has come not because of banks, but despite banks. That's the beauty of the sector. It's worked just because they have not been efficient. A banking officer doesn't really want to entertain a $500 loan. Now, if you go on to the next slide, I will try to explain the cost structures of a microfinance institution, because if you look at it, the numbers, right? I mean, the cost of a loan for an individual is approximately around 25% or 26%. Now, you would, hearing that, you might fall off your seat. But if you actually look at the operating cost and you look at the financial costs that a microfinance institution incurs, and we're talking about best in class across median values as well, the statistic here on the right-hand side basically has two graphs. The one on the top is the operating cost, which is based out of the operating cost, 70% is employee cost. And the bottom chart on your right is the finance cost, or the cost that they incur to get the funds for on-lending. So if you look at the highlighted portion in red, you will notice that the finance cost itself is 13.5%, 14%. That's the cost that they raise. Now, I want you to juxtapose this with the fact that the government security yield typically in India is almost around 7.5% for a 10-year GSEC. I mean, you would be familiar with discounting rates, etc. So we're looking at a government security sovereign guarantee at 7.5%, and you're looking at microfinance institutions getting it at 14%. That is almost nearly double of what the government security has. A AAA security typically gets it 25 bips or 50 bips above the GSEC rate. So AAA security would probably be around 7.75 or 8%. But even the best in class still get it at a very high cost, right? This sector, for some people, has been a sector which is, the last resort. The prices are quite high. This is demonstrated here in the price, in the interest rates. Now, it isn't that one hasn't tried to reduce the rates, but you'll notice that during COVID, pre-COVID, and post-COVID, the rates have more or less remained quite constant. So this has been an anemia for the sector. The cost of funds is high. Government interventions have been tried, but eventually the price points are high, the rates. Now, if you add along with that, the operating cost. Now, if you look at the operating cost is something like 9%. So you're looking at the cost structure, the bare minimum cost structure being 14% finance cost plus 9%. So you're talking about 23% cost at zero profit, zero loss, forget credit costs. Now on 23%, you basically have to add a credit cost. And like we all saw in the previous slide, the credit cost on a steady state basis was something like around 2%. So you're looking at no profit, no loss at 25%, right? So next time, don't fall off your seats, when you hear a 25%, that's just because the cost structures are so high. Now, there are two important elements, the finance cost, which is in a way extraneous, and the operating cost is something that is controllable. Now, why is that so high at 9%? The 9% is basically the cost of geographic dispersion, the need to have branches and field officers in rural areas. And the fact that you have probably around 30% of staff that are churning every year attrition. So if a typical loan size of 24 months, by the time the borrower is repaying his or her loan, more possibly than not, the loan officer would have changed. So there's a high attrition in this place. There is a lot of travel that is involved. And the biggest problem is there's a lot of cash. Now, the microfinance sector has solved the disbursement problem. Disbursement does happen digitally. It happens at the click of a button. But the collection, which is the biggest challenge, has not been solved yet. What I mean by that is that collections invariably for almost 99% or 95% tend to be cash. And you can think of it, the employees or the field staff are basically collecting the cash and depositing in the bank. And that runs a huge operating cost and also an operational risk involved with that. You're talking about not T+1, you're talking about T+2, T+3. That itself is a large cost. And if one is able to minimize the cash portion, that is the cash collections, then one is able to optimize the operating cost. And if you're able to optimize the operating cost, you're able to then pass through those benefits back to the borrowers. And also to give you a perspective, the average home loan rate is 8%. So you're talking about a cohort that is getting extremely high rates because of the fact that the operating costs are so high. So what one needs to solve is one needs to solve for the operating costs, because the finance cost, like I said, is extraneous. You cannot really control that as a economy. It moves up or down. Also, what happens is that the average loan officer is able to service approximately 430 borrowers. That is approximately around $200,000 of business that a loan officer handles. Now, if you compare this to a bank officer is able to manage probably around $1.5 million worth of business, whereas the field officer is able to only manage $200,000 worth of business. So you're talking about a 7x delta. And the 7x is primarily coming from the fact that there is intense field operations, there's intense travel that is required to remote corners in rural India. There isn't too much of density. And that's basically what causes this. Like I mentioned, the governments have tried to make interventions, but those interventions have turned out to be massive challenges. There have been guarantee schemes that are floated by the government at the central and the state level. These are called Mudra loans. These are farmer credit cards or Kisan credit cards. But what has happened is whenever government, I don't know in the UK, but whenever government introduces a scheme, the first thing in the borrower's mind is there is going to be amnesty. And now when that credit is given with the belief that there's going to be amnesty involved in that, you don't have to pay it back, it corrupts the entire credit culture. And due to that, places like, there are some states in India, the southern states of Andhra Pradesh and Telangana, where the government has given so many such freebies that organizations have stopped borrowing these states because the credit culture has changed for the worse. So people just don't borrow. And who are the which individuals have the biggest challenge? The borrowers themselves. So if you look at it, it's a vicious circle. They got freebies of amnesty, not paying back to the government. They thought they were happy. But because of that, lo and behold, you don't have commercial organizations coming and giving them loans, and they end up suffering. So it's a very vicious circle, which the government tries to get itself out of. But due to political reasons, some states are caught in this catch-22 situation. So the best way is to let this sector evolve. The government can facilitate an ecosystem. The government or governments cannot be the ecosystem. It has to evolve organically. If you look at the left charts, this is a representation of leverage. So the median values of leverage are approximately 3.5x. So the finance cost does have a very significant repercussion, because you're talking about debt to equity ratios being deeply impacted by finance costs. And if you look at the topmost chart on the left, the average financial expenses are close to 50%, and the average cost of personal and other expenses, that is basically operational cost, is almost 56%. So you're talking about a financial institution whose costs are much higher than its financial expense. It has to work the other way. Typically, if you look at a mature system, the financial expenses are much higher and the operational costs are very low, right? Because the financial institution is heavy on financial borrowing and then lending. But in the MFI business, it's the inverse. Like I mentioned, it's because you need to optimize on the operation costs. So this is a challenge that has continued in the sector. Now, there's a survey that was done with borrowers. If you move on to the next slide, this survey was done in 2016, 2017. It might look a bit dated, but it's quite telling. If you look at it, the survey was made that why do people not borrow from formal institutions? And the answer that came was they had multiple data points. First of all, easy availability. People borrow from family, friends, or unorganized money sharks because they can't easily get loans. There is no paperwork involved, but in a formal institution, there's significant amount of paperwork that is involved. There's significant amount of collateral that is taken. It's a long process. You don't know when you're going to get your money. Now, all of these force the borrower here, in this case, let us call her Rajni. They force Rajni to say, hey, you know what? I don't want to go through all that trouble. When I know there is someone I can get credit from, now the rates of interest from that loan shark might be exorbitant, but I know when I'm going to get my money. There's no paperwork, so I better go and get money from him. So these are the challenges that one has to solve for. We don't have to solve for us, but rather for Rajni, the borrower. Now, the next slide is basically giving you a data point of where India was. And, of course, we all know India has a significant population, But what has happened here is the real India. And when I say the real India, typically what you read in the papers, the innovations impact the top 100 million in India. When you talk about, Amazons or Flipkart or Ubers or Ola or, the unicorns, their addressable market is primarily the top 100 million users in India. But you're talking about a country that's got 1.5 billion of population. You need to have a system for financial inclusion that is not for the top 100 million. It's for the others as well. Now, due to the fact that there's been a data boom, for example, the average cost of a mobile connection with practically unlimited data, you can stream as much as TikTok as you want, as much as YouTube you want, is something like less than $2.50 a month, which is drastically low. You have Aadhaar, which I'll take you through in the next slide. Aadhaar is basically we can just go back to the previous slide. Aadhaar is basically a biometric, foundational mechanism, which is simply the social security system. This was something which was innocuous. It was started with the intent of cutting down leakages in subsidies to the poor in various forms, pensions and subsidies, primarily to cut leakages. But if you notice, innocuous inventions are the foundations of fabulous inventions or innovations. And that's what Aadhaar has become. This is a country that has got 800 million mobile users, almost half of the population. And you also have to count into fact that almost approximately you have 200, 300 million users who are uh, below 18 years of age. So practically almost around 80% of penetration of mobiles you have in rural India. That is a 50% penetration of mobiles. Social media accounts are significant. And if you look at the stats there, they're almost the same as the bank accounts. Bank accounts are no longer a problem in India. 80% of them are covered by bank accounts. But the challenge is the cash flow through the bank accounts, right? It's like you have a study table. That doesn't solve the problem of studying. You need to actually sit there and study regularly, right? That's been the challenge of a bank account. A bank account exists, but the behavior that has evolved in the bank account is once the money is deposited, once you get pension, once you get a subsidy in your account, you go and withdraw the money and you take the cash back home. So banks have helped, but they have not been able to translate this entirely into financial inclusion in the true sense. And again, I mean, these data points are interesting because you need to juxtapose, say, the Britain's population, which is, I think, 67 million people. Due to these innovations, due to the cost reduction in data in mobile, a woman who's there in the hinterland in India, probably 500 kilometers away from any city, has the same access to technology as I do sitting here in Mumbai. However, digital behavior is not instantaneous. It is evolutionary, right? I mean, it's like Charles Darwin, right? I mean, the evolution of species, right? Because behavior change works as ripples in a pond. You have the inner circles, that is basically urban centers, and then you have rural. So it takes time for the behavior change to happen. But there is a strong possibility of that change happening. And some data points I'm going to throw at you, which is in the next slide, which talks about how this has evolved. Now, if you look at this, the chart on the extreme right, which looks like a pole, Aadhaar, like I mentioned, the innocuous invention that happened in 2010, and this is something that has survived politicians, right wing, left wing, central, all types of characters through across the states. It has survived governments because people saw the benefits of this. And I said, like I mentioned, it was just to cut down subsidy. It was just to become more financially secure, to have a lower debt ratio for the country. But what happened is this stack, which is called India Stack, started getting formed. And one of our directors and contributing founders, Nandan Nilekani, is one of the proponents of Aadhaar. They built Aadhaar and they built layers on this Aadhaar one by one. And that is what became India Stack. So what started as a biometric identity, and I mean, people do have concerns about privacy, but what happens is this is run not by the government, but by a different institution in itself, UAIDI. And that data is not shared with the government. And it doesn't mean that if you have a unique social security number, anyone has access to that number, they can do anything with it. They can't, because it has to be biometrically or verified from an OTP standpoint. So this layer, we started for identity, then moved to what we call gradually through the bank accounts. It is called the Jan Dhan accounts, which is having significant bank accounts for everyone, linking those bank accounts to the Aadhaar. Then it introduced e-signs. E-signs are basically signatures where there is no paper involved. You can sign, and it's basically like DocuSign, but DocuSign may not be as legal, and e-sign is much more legal. It's as good as putting your thumbprint or your signatures are there. Then what happened is we had this concept of what is called an aggregator, account aggregator. Imagine that, let's say Emma wants a loan, and there's a service provider that, hey, we'll give you a loan, Emma. And then they told Emma, why don't you give me this, give me your last 6-month bank statements, give me your social security details, give me your current employer, I need to be signed and stamped. And now that takes Emma some time. But in account aggregator, what you can do is by providing consent, you're able to automatically pull that data instantaneously. You're not talking about any paperwork. It all exists. It's all shared instantaneously, and Emma's decision-making can be made on the spot. So that became an innovation. And the best or the most important innovation is what you can see here. Can you see the QR code on my screen? That QR code, the simplicity of that QR code which was actually, it was invented by Denso Corporation in Japan, for tracking movements of machines. So they could be tracked in real time. That has become ubiquitous in India for payments. With that simple QR code, that humble QR code, the volume in UPI, that is Unified Payments Interface, that is built on Aadhaar, the India stack, has been incredible. If you look at these charts, I mean, these charts actually need to be represented on a log scale. They are so crazy that you can't really understand these charts. To give you a perspective of these numbers, it took UPI 3 years to cross 1 billion transactions, right? And we're talking about transactions that are probably something like $5 to $6 on a median basis. So it took 3 years for that to happen. The next billion came in less than a year. The next billion after that took 10 months. And the next billion just took 3 months. And if you see, so this next billion is November 2021. Now, if you see the statistic as on September 2022, 6.8 billion transactions were processed on Aadhaar-based systems, that is the UPI. You talk 6.8 billion transactions, which is, to give you a perspective, the amount of the volume is 6 times the mobile connections in India. You're talking about a volume that is basically saying, if on an average, a user is using UPI payments or the humble QR code 6 times in a month. And these are not for large amounts. Now, you have Apple Pay, right? I mean, for some people who are very privacy inclined, but Apple Pay, the QR code there is linked to your credit card. There is a cost, right? You don't have systems in place where the cost of a payment is zero. This has been the revolution in UPI, that they built payment, the government through various innovations and inventions built the payment system, and the cost to a user is absolutely zero. So a mom and pop store by the corner on the street and a shop in a high street or in a mall all can have the same payment systems. None of them are excluded. And so can a financial service provider, and so can a person who's providing a peer-to-peer loan. So the innovations in payments was solved significantly. And if some of you are familiar with the concept of two-sided platforms, or what we call disintermediation of two-sided platforms, classically Visa, MasterCard, and to some extent Amex were these monoliths who control the two-sided platform, one side of it, right? Right? How you have Uber that controls one side of it and you have users on the other side, right? Very, very difficult to break Uber. But UPI came in with a structure where the cost was zero. The QR code, which is shown here, this is actually my QR code. You can actually, if you take your camera out, it'll point you to this and make a payment to WhatsApp to me. So that was just, you can print it on a piece of paper, you can send it anywhere else, and you can make repayments. You can do that fantastically, without any hesitation. But Master and Visa had a 1.5% cost. So UPI disintermediated the entire ecosystem, brought in the cost to zero, and thereby actually saved people money. That's one of the greatest innovations there. If you look at the statistic there, the one that I've circled, almost 83% of transactions on a P2M, that is peer to merchant, are 0 to 500 rupees, or basically, almost around $6. Again, very low, huge volumes. Similarly, P2P transactions from me to Emma, me to Soham, those are again 60% of them are 0 to 500 rupees. It is not a product that is for the elite. It is a product for everyone, right? I mean, that's the beauty of this product. Everyone can use it. India's richest man uses this. India's poorest man can also use this. The other cool stuff that happened is the example of Emma that I gave you. Now, Emma had to do what is called her own KYC. So probably, when you've gone to some banks, or places, you have to prove your identity, right? I mean, are you an illegal? Are you a legal migrant? Your social security number, etc. And before Aadhaar came in, that was a big challenge because there was paperwork. There is frauds. People can just put my photo on Emma's social security or Soham's social security and go and take a loan. And that used to cost a fair penny. That used to cost probably around 1,000 rupees on an average. That is basically almost around, maybe around $15 odd, that process, because you can think about it. You have systems in place. You have people verifying that, cross-verifying that, repeatedly updating that. But with Aadhaar, that cost came down from $1,500 to $20. That's $20 is probably something like around 10 cents or 10 pennies. That's the dramatic cost reduction that happened because of KYC. And it is much more stronger in verification terms because this is instantaneous. You get it on the fly and it is verified by biometric means as well. So it wasn't just a tool of larger stores. It became a tool that everyone could use. So the layers on which India Stack is basically 5 layers: the biometric identity, the virtual ID, right? For example, my virtual identity is my mobile number at UPI, right? I mean, there's something called PSPs, payment service providers, etc., where you can have banks having it, you can have startups having it, you can have anyone who has a virtual ID as long as they're regulated. The third is a digital locker. A digital locker is where all the loan agreements, where all your licenses, driving license, etc., is stored. So if someone wants to get that confirmation from Emma, they can just get access for that point in time to verify identity from the locker with her consent. And then they know the evidence that she's actually a real person. The fourth is the payment interoperability, right? So it isn't that if you're on one wallet or another wallet, or you're with Apple or you're with Amazon or Google, there is no relevance. Anyone can pay anybody, right? And the last is e-consent, right? E-consent is either biometric or it is something that is given on OTP based. So this is the evolution and the revolution in some ways that Aadhaar has made possible. In the next slide, what I will try to walk you through is what are we doing about this in Avanti, right? So the classical model, I think we can move the slide. So the classical model has been that you have a high operation cost, you have a lot of people, a lot of feet on street, because like I gave you examples of the fact that there's a lot of cash involved, people have to move around, deposit cash. It's a very operational intensive business. But what we try to do and what we are doing in Avanti is we have created an open network of partners. What that means is our entire LOS, that is a loan origination system, or LMS, that is loan management system, is integrated and has open APIs where we can work with different players across ecosystems. They just have to integrate with our API system, and we're able to make them use our system. The best example that I can think of here is I'm sure everyone has looked at has used Netflix, Disney Hotstar, or Amazon Prime, right? And then you have content that's hosted on that, right? I mean, it could be any content. Now imagine that if that platform, Netflix, was for free. That's what we are trying to do at Avanti. We are creating that platform for free where people can host their content in a way, bring in their own borrowers. They can use our entire system, which is what we call a hyper-local system. They can design within our system, within the guardrails. And what I mean by design is Google Maps, Wikipedia. People can create content there. You can lay down a road in Google Maps. You can put an entry in Wikipedia, but that has to be confirmed by other users as well. So that's a system that we have created. It's almost like a lump of clay. It is flexible. Tenures can be defined. Durations can be defined. The use cases can be defined as long as it fits the guardrails that we have. It enables paperless transactions, presence-less, and less cash. Less cash because there is still an element of cash. We are trying to move towards cashless, but there is still, that challenge. The most, I would say, probably the coolest thing that we have done is we have what I call crowdsourced underwriting, right? Now, your classical underwriting models are basically you take credit scores and people who have done econometrics or you've done, modeling. You'll probably do regressions. You'll do logistical regressions as well, and then you determine whether to give a loan or not, etc. Now, that is important. But we've gone one step ahead. Imagine that if you are a community, when I say community, there's basically a geographical construct, not a sort of any sort of other community. Say you're in south of London, in a particular part of London, right? And that community is dense, right? I mean, you have a lot of people there. Now, imagine that if you have, say, Mr. Akbar Ali, who wants to take a loan, and there are other borrowers who have taken a loan from Avanti. What Mr. Akbar Ali will try to do is he will just reach out to them. Hey, I'm taking a loan from Avanti. Then you have a Mr. Eric, you have a Mr. Alex, and say you have a Miss Emma. They will come and recommend Mr. Akbar Ali. Now, what does that mean? We have brought in a way your Instagram, LinkedIn, Facebook, where you are liking someone, you're recommending someone, but you're not guaranteeing the person. You're saying that, hey, I trust this person for a loan. So we are crowdsourcing the credit underwriting to have, what we call the community-based governance mechanisms, right? And of course, there will be people who will game this, right? There'll be people who will probably want to do this because they have something together and they want to take some money out, etc. But that is the edge case. We can determine who are the players who want to do this, but on a sustainable basis, the crowd is intelligent. I like to give this example about honeybees. If you look at honeybees in nature, when they're on the beehive, a honeybee is a small individual, cannot probably do much harm to a bird, which is larger. I mean, this is a bird, this is a honeybee, right? I mean, such a small honeybee. Can't do anything. The bird comes and eats a honeybee. Now, when the hive is there, you have a bunch of honeybees around there. So what the first honeybee does is, the first honeybee on spotting the bird, right? It starts doing almost like a Mexican wave. It starts waving its wings. The next honeybee does that. The next honeybee does that. And then what you start noticing is the entire the entire beehive is behaving like a Mexican wave. And this large beehive is now intimidating to this bird of prey. What I'm trying to get at is that crowdsourcing our intelligent systems, whether in nature, honeybees, whether you look at Google Maps, whether you look at Wikipedia, there are always going to be edge cases. But we are working towards layers that are able to give you much better credit quality than what is classically known, as alternate scores. And the other thing is, I mean, people are trying to say, okay, let's scrape data. If you have a user, so I had this fintech startup that I met, and they said, hey, you know what, we're very proud of the fact that when someone gets his salary credit in their a message, we're able to send a message next in just 5 minutes, say, hey, pay back your loan. Now, if you look at it, there is a lot of violation of data privacy. And the Indian regulator also woke up to this and has banned that. So people cannot have, cannot sneak into the data that you have on your phone. People need to give consent. They can withdraw their consent at any point of time. So you cannot have systems. And there are startups also in developing countries, and there are some large startups in Africa who try to, impose on your mobile phone. But that is something that is not sustainable. You need to understand the customer much more rather than just scraping data off the phone. So that in India now is prohibited. You cannot scrape data on phones. You cannot eavesdrop on phones. You cannot force someone to install an app on your phone. That is not possible. So who are left is real serious players are left who are actually able to determine, credit scores, there. What we do here, if you see on the right-hand side, the potential partners, we work with what we call community partners and commercial partners, right? Now, what are community partners? Community partners are those that create input interventions. When I talk what input intervention means is that they help them purchase seeds at lower cost, buy raw materials at lower cost. They also help them in output interventions. Output interventions are market discovery. For example, we have a partner who helps discover price of organic cotton and supplies it to the H&Ms and Zaras of the world. So they create a marketplace, they're able to get better prices. So this partner exists in input interventions and output interventions, and we then facilitate throughput interventions. That is what is credit. These are community partners, and there's example under community partners that's called Self-Employed Women's Association. It's quite large in India. They get women together to work as a strong network. That network could be for social causes. That network could be for business purposes, for trading, for acquisitions, etc. They even run a bank. That is also under the community example. We also then work with commercial partners. Now, commercial partners are partners who can be business correspondents, like I mentioned earlier on in my presentation. They are basically organizations that are very strong geographically in a particular district or a particular region. We also work with agri-techs. For example, we work with one which is into a dairy startup. We work with a supply chain startup. We work with people who are OEMs of agri machinery. We work with multiple such players. The intent is that we don't want to alienate NGOs or say that, hey, you cannot work with NGOs. Now, it isn't that you can work with NGOs. It's not, it doesn't mean that we work with NGOs so everyone can work with NGOs. You need to work with community organizations that understand credit, right? I mean, that's one of the things that we have learned. You cannot work with organizations just because they're doing social good. Everyone wants to do social good, right? I mean, no one's denying that. But you need to get the money back, right? I mean, this is not a grant, this is not charity. So you need to work with partners who are able to institutionalize the concept of credit, financial literacy, digital literacy in the true sense, and most importantly, are able to work with you to co-create the product. Now, what do I mean by co-create the product, right? Now, imagine that there is a cattle that is being bought in the southern or the eastern coast of India. What is the cost of investment that cattle? What is the payback? What is the frequency of repayment that they get from the dairy cooperative versus a cattle that is bought in the eastern coast of India? They are not synonymous. They are very different. The yields are different. The varieties of the cattle are different. But what you're trying to do is you're trying to create a hyper-local product. And we're trying to build in the tacit knowledge that exists on these different type of products. It could be a Gir cow, it could be a Jersey cow, it could be a variant of a mix of both of them, and get that data onto our system so that we know when someone is going to buy this particular type of cattle, we know what to expect as a repayment tenure. We know what to expect that if he or she is applying for a 50,000 rupee loan, we know the cost is only 40,000 and 10,000 rupees is what they're applying for consumption smoothing, basically trying to get some more money to pay off their expenses. We can predict that, right? And that is only possible if we co-create the product along with the partners. This was just an example, but you can imagine this at a massive scale. And the reason we work with partners is to convert the tacit knowledge that they have. We work with probably around 70 plus partners into more explicit knowledge into our systems through data. And through this, we create regression models, different predicting outcomes, etc., that we are able to do. What we also are trying to do is let the community work with our own system by itself, right? I mean, like how you have cooperatives in many places. There's an example I like to give, Uplift. This is a fantastic insurance cooperative that allows the community to just use their system and design and decide to whom to give an insurance. The community decides if the claim is genuine or not. The community decides the percentage of claim. The community decides the premium amount. Now, imagine at a large scale, if you convert that from an insurance standpoint into a financial inclusion loan standpoint, that gives so much of power to the community. And the fact that you're owning it yourself empowers the community to take decisions that are better for the community. So that's what we're trying to do, create a robust system, create interlinkages between the demand side, which are the community and commercial partners, and the supply side as well, where we work with banks, shadow banks, development financial institutions, social impact asset managers, where they can then use Avanti as a box. The supply of capital that is coming in then can be used for demand, and it functions fantastically together, because then the supply of capital in a way is limitless, right? That's what we are trying to do. We're trying to design what I'd like to call cash flow based products, not products that are operationally specific, but cash flow deterministic. Now maybe I'll move on to the next slide and throw some stats, right? So this is basically the customer profile that we work with. You can go one step earlier. This one, right? So if you look at this, we typically work significantly with new to credit customers and underserved customers. These are basically customers that have thin credit profiles, have not taken much loans in the past, but we work with them. Now that is counterintuitive to many. We think, hey, they don't have a credit history. How can you vouch for them, and how can you really understand how they're going to repay? And that's where our data comes into play. We work with 90% women borrowers. There's a reason. I'll take you through the stats, in a bit. We work in counterintuitive ways, and in some ways, that is because of statistics. Now, I'll give you real stats on women borrowers. Delinquency levels, sure, William. Okay, all right. So delinquency levels, of women borrowers are probably around 1.5%. That is 90 plus DPD. That means 1.5% of women borrowers are overdue by more than 90 days. But when you look at the statistic for men borrowers, that is 3.5x. That stands at 5.5% delinquency, right? That's a data point that we have actually seen. Now, what does that teach us? If you intervene for the men borrowers, you're able to then reduce the possibility of them going bad, because the women borrowers are automatically going to become better, because statistically, that's what our data model tells us. The next thing we notice is new to credit customers who are new, right? We notice that their 1+, that is 1+ par, 1 day overdue, is a bit high. It's around 12%. But on a steady state basis, this new to credit customer has the same 90 plus delinquency level as that of a medium risk customer. And we thought about it, why? And then when we researched, we understood that this new to credit customer wants to build his or her credit history. And that's why it's working as a good customer and not a customer that we should alienate. On the contrary, we should embrace these customers. We also found out there's a significant correlation in the ticket size of the loan versus delinquency. So a loan of 50,000 rupees, which is probably around maybe $550 or $600, has a 2% delinquency level, that is par 90 plus. Whereas if it went above that limit, the delinquency went as much as 10%. So that's why you will see that these ticket sizes are smaller, because these are again statistically proven, they're linked to household incomes. We also do get household scores from people. That's also how, deterministic behavior that we determine, what are the predictability, how much is a fixed income and the obligation that they have. We do different type of things. But what I'm trying to mention here is that you need to look at data, and we've been able to use data to create models and also crowdsource data. So we've gone one level above. Now, in the interest of time, what I'll do is probably I'll skip the next slide, which is the slide number 9. We can probably go directly to slide number 10, right? This is a beautiful, chart. The woman in the middle is, we'll call her Rajni. She's taking a loan. Now, this chart that you can see here, and it's done by an organization called the Digital Fifth. It just portrays all the fintechs that are there in India. Now, Rajni wants to take a loan from Avanti. The field agent of the partner inputs her data on an assist mode. She can't do a self-serve because she's not digitally literate for a loan. She can access WhatsApp, TikTok, but she can't, apply for that. So now Rajni's application, and look at the ones that are circled in, orange, light ones in orange. Rajni's application then goes to what is called CRIF Highmark, that is a credit bureau, along with Experian, which is on the credit bureau, to get her household score. It then goes to what is called the Aadhaar bridge via Verify Digital, which is the bottom in the middle, to verify her identity. And then after that, once the identity has got verified, it goes to what is called an account aggregator, that is Perfios in this case, who is able to determine that, hey, I'll check her bank statements. Is she credit worthy? I can pick that up. Yes, credit worthy, decision making is happening. Then Avanti uses what is called a platform, right? The example that I gave you, where we have banks and other partners who can work with us. So Credit Avenue on your extreme right of the screen is a co-lending platform where banks can push in money, and that money is basically pulled from the bank account post the credit underwriting that we have done. So this is co-originated together. Then finally, when this is happening, agreement is happening, it goes to Digio, which does an e-sign, which is an Aadhaar-based sign. Then when a collect is happening, it goes to what is the UPI system, where on an automated basis, monthly basis, money is deducted from her. And when the disbursement is done, money is deposited in her account. And the beauty of this is that all this is happening wherever she wants to do that, wherever she sits, whether in rural India or in urban India. She just needs an Aadhaar ID and she just needs a phone. That's the only thing that she needs. And all of this is happening instantaneously. That's the beauty of this, right? This entire ecosystem is working seamlessly and together for her to solve that. Now, moving to the second last, the penultimate slide, uh, you know, yeah, microfinance or financial inclusion has had multiple phases. The first is 1.0, what I call the Grameen. And I believe you also have a crash course on that. The next, and this is in the 1980s by Yunus Khan. The next is what were digital disbursements, where cash was not being disbursed, it was digitally reaching the bank account of the borrowers. The third revolution is the digital KYC, where you did not need paper to really verify any of people's identities. It can happen instantaneously with an OTP or a biometric device. And the fourth revolution, which is impending, which primarily cuts down the operational cost dramatically, is the community underwriting. The example that I gave it, we have to reduce the 9% cost of operations and bring them down to sub 1% or 2%, because then you're able to really reduce the cost of credit and include much more, exclude in the entire financial inclusion. The chart that you can see here is something that is being created by BCG, Boston Consulting Group. If you look at UPI is the zero cost transaction that I mentioned. In 2019, it constituted 16% of overall non-cash transactions. In 2022, it constituted 63% of non-cash transactions. And in 3 years, it's basically eaten everyone's pie. And in 2026, it's expected to become close to around 73 to 75%. So the repayment behavior is something that is definitely on the cards. People will start paying, digitally through the humble QR. You can say you can incentivize people to pay digitally, but you can only incentivize that much. What is more important is that it needs to be a behavior change that needs to take place. And there are multiple innovations that are taking place across fintechs, in agri-tech. And there's a new thing called Kirana Tech. You know what's Kirana Tech? Kirana Tech is mom and pop store tech. That's basically converting the mom and pop
Sushil sir,
store. Yeah.
sorry to interrupt, but I think we have to vacate the wheel by 5:15. So can we do the Q&A?
Yeah, I think we'll finish this. So the mom and pop store tech is an ATM anywhere. You can withdraw cash from anywhere. You can go to the next grocery shop, withdraw cash, deposit cash. Anyone can do that. So you don't need an ATM. This is an ATM on the wheels on the fly. This is the amount of different innovations and interventions that have happened. My last slide is just something that I liked a lot. This is by Jeffrey Sachs. He's an economist. It says, it's very intuitive and very self-explanatory. The key to ending poverty is to enable the poorest of the poor to get their foot on the ladder of development. The ladder of development is not far. The ladder of development hovers ahead, and the poorest of the poor are stuck beneath it. They lack the minimum capital necessary to get a foothold and therefore need a boost up to the first rung. That's what technology can do. And I'm a strong believer that technology is what can do the 4.0 revolution in microfinance. I will now, ask if there are any questions, and more than happy to take any comments, etc. from the crowd. Yeah.
Well, I had a quick question. I just wanted to clarify. Did you say that for the net capital that you guys were working with, like you said, somewhere around 40 billion USD, that most of that amount of money was being transacted through cash? Is that like what you guys have to like work with right now?
Yeah, so that's a very interesting question. So the industry is for, if I think on the first slide, the number of the industry is, the gross loan outstanding is $40 billion. And typically you have a 2-year tenure. So on a yearly basis, you're talking about disbursements go digitally, But the collections of this, so 40 billion divided by 2 is 20 billion. So you're talking about 20 billion worth of cash collections. And these are very, very small value collections. These are probably something like 500 rupees or 600 rupees that actually happens. So 20 billion of cash is just coming in from microfinance. And that's the reason why the cost of operations is so high. By the way, we have introduced some very cool technology because cash is a problem, right? I mean, when you have cash, someone can steal the cash can be deposited later. But we have introduced wallets. So what we do is, supposing you're making a repayment and I'm the agent on the field. Now you made the payment of, say, let's say $5. Now you need to give me an OTP when you make that payment. And that's an immutable record in my wallet that you have paid me $5. Now I can keep collecting for 50 people, but at the back end, Avanti now knows that cash has been given to Sushil of $5 from 50 people. So I'm able to monitor the cash. So it is cash, but then in a very different way, we're trying to digitize the cash.
Do you mind giving your introduction?
Oh, yeah, sorry. I'm Wesley and I study health and international development. Sorry, but thank you very much.
Sure, sure.
Hi, so I had one question. So what exactly comprises under the operational cost of a typical MFI?
Again, very good question. And the answer to that is very simple. 70% of the cost is just payroll. Now, to give you a comparison from a bank, operation cost just 40% is payroll. That means on a like-to-like basis, if you compare the bank and the microfinance institution, the bank has 30% more headroom to introduce technology. That because you're looking at a microfinance institution, 70% cost of payroll, whereas a bank only has 40%. And the balance 30%, a microfinance institution cannot optimize too much because payroll is very high. So that's why it's again important that you reduce payroll by creating technological abilities that people don't need to go on the field, right? Again, to give you a comparison, I think I spoke about it. $200,000 on an average is what one officer field agent handles, whereas it's $1.5 million in a bank. It's dramatically different. How can you empower that field officer who handles 430 loan accounts to handle 4,000 accounts? He or she can only do that if they don't need to be scurrying around from one place to another to collect cash. You need to digitize collections. Otherwise, this 400 cannot be improvised much more.
Thank you. Hi, Sushil. My name is Bharat. I'm following up on the Soam's question. Obviously, following up on Soam's question about operational costs. Obviously, there are things that you can implement in order to reduce those costs. So my question is basically, how long are we seeing until those implementations basically take effect in the future? So there are obviously ways to reduce operation costs. It's about how long it's going to basically take to reduce it. Could you shed some more light on that?
Yeah, that's also a good question. So like I mentioned, there's a lot of behavior change that is required to reduce, to bring in technology. Something that can be very intuitive to a person in an urban setting can be very counterintuitive to someone in a rural setting, right? For example, if you look at Germany, if I remember correctly, people do not like to transact digitally because there is distrust of the government. They are deeply, insecure about, anyone knowing their transactions. There's a heavy cash economy. So you're talking about a place, where you have a developed country, where you have significant cash dealing. That is behavior, right? And on the other side, you will have countries which are developed that have significantly low. Like you look at Southeast Asia, significantly low cash dealings, primarily digital dealings. Now, in a country like India, for that behavior change to happen, we are talking of at least something like around 5 to 7 years, because it takes place as ripples, and these ripples take time. And, I mean, funnily enough, the reason why digital transactions have worked out in India are, again, I would not call them innocuous, but events that have happened that were outside the common man's control. The first was what was demonetization. They basically changed all the currency notes in 2017, right? I think 2016, 2017. So it forced people to work digitally. It forced them. You don't have an option, right? You need to do that. The second was COVID. You need to make payments. You don't want to have soil notes that are giving for payments. So that became a behavior change. People are getting money in their bank accounts digitally. So there has been a delta change. For example, in Avanti, we have, say, close to around 85% cash collections to the wallets that I mentioned, 15% are digital. But how long will that take for the 15% to move up to 85%? It takes significant amount of time. We are talking about at least 5 to 7 years, because you must understand that the average household that we're talking about earns an annual income of probably around $1,500 a year, right? And when you have $1,500 a year for them, what is key is until they reach a certain self-sufficiency, they will invest in assets that are physical. They will invest in cattle. They will invest in gold. They will invest in things that they can see and touch. But once they become more financially secure, then they start moving towards financial transactions digitally. But it happens in peri-urban areas or semi-urban areas. If you look at Mumbai, you go 100 kilometers from Mumbai or say 100 kilometers from Bangalore. These are rural settings. But the impact of the ripple is much more profound there. It's like, if probably you have cousins in the US, of a new game that has come there. You come back here, you talk about that. People say, hey, that's so cool. Let's do that. So that takes time, but it's at least 5 to 7 years is what I would look at, because they've also started something which is the UPI, which is you can make payments even on feature phones, right? Now in the developed world, you typically have smartphones. In India also, there are significant smartphones. In the family, at least there's one smartphone in rural India. But that doesn't mean everyone has access, right? Feature phones are still cheap, right? So there is innovation that is happening where you can even make payments through feature phones. And you're talking about feature phones, the cost of a feature phone can be as low as something like around maybe sub $20. And that $20 phone can last for at least 2 to 3 years. So the short answer to your question is 5 to 7 years, but that will take much longer time to be across the system, but it's definitely a very good start.
Thank you. So, Emma, any questions? No, I think that is it. Okay, so thank you.
Yeah.
So yeah, I hope I was able to give you some perspective on the microfinance sector, and I try to make it as less boring as possible, because I'm a big believer in fintech for the bottom of the pyramid. I once was an investment banker in corporate finance, which I do believe is a very storied profession for a lot of people in LSE. But I think there's a lot of PPT, right? It's good on the outside. It's like what can I say? It's a faux leather jacket. It looks nice, right? But it's faux leather. Once you start getting into it, you start realizing. So I was once in corporate finance, then I moved into consultancy, and since 6 odd years now, I've been in the fintech space. A lot of work in the bottom of the pyramid, and what you realize is that instead of wearing a faux leather jacket, wearing a t-shirt is even more cooler. And you actually have a lot of fun doing that. So, to those who really want to go in, Wall Street, etc., do that. But trust me, the amount of innovations, the opportunity to be millionaires, if not billionaires, lies in the startup ecosystem. And if you can solve that for a population scale, that's when you can actually make a lot of money. You can make much more money by giving solutions rather than by being bankers, right? So, I mean, there is of course, a part of us who is a capitalist. But, if a capitalist is able to solve solutions for society at large at low costs, that's a good capitalist, right? So at least that's a philosophy I believe in. Try to make a change. it doesn't mean making money is a bad thing, but if you bring change, and I hope some of you kids, do that, right? Bring change, bring innovations, and payments now at least is sorted. The innovations are on top of payments. How can you create much more innovations across the globe in different parts of the world? So yeah. So it was super fun, a small cohort of you guys, but I hope I was able to add some value to your thinking on microfinance. Microfinance is not boring, and especially if you love statistics. I love statistics. You can play around with data, and you can get hundreds of thousands of data points. I have done that myself, and that gives you a kick that you're able to actually make a decision, right? So yeah, and if any of you want to be in touch, you can look me up on LinkedIn. Happy to be in touch with you, or in case you guys want any perspectives on the fintech sector here. I do invest a lot in fintechs in India, strong ecosystem of fintechs. Happy to give my 2 cents on fintech. So in India, fintech is really, really big. You can imagine the diversity of the country, the use cases, and if you just look back at that chart that I'd given, right, it is immensely powerful. Huge amount of money, even more than China now that's coming in, because we want to solve and take it to the rest of the world, right? It's not something that is just there in India. For example, the QR code came from Japan, Denso Corporation, but India naturalized the QR code, which Japan did not, right? I mean, that's what we kind of were able to do. Yeah, that's it. I'll probably end there and not take much more of your afternoon.
Thank you very much.
Thank you so much.
All right. Okay. Thanks so much, folks. Have a pleasant Wednesday ahead. I hope you get some of the sunshine that is usually there in Bombay, in London, because I don't think London gets a lot of sunshine.
Okay. See you.
Thank you.
Super. Good speaking to you guys. All right.
Bye.
Okay. Bye-bye. Bye, folks. Bye. Thanks, Emma, William, and so on. Thank you for this. It was fun.
Yeah.
Bye-bye.